Yeah. So as I said, I asked you to refer this option pricing. So today we'll discuss about the option pricings. Yes. So these options are the derivative instruments. Generally, the objective of options is to minimize the risk. So options comes under the category of derivatives. Now we try to understand what exactly these options are. So generally, we will be having two options. One is call option and the other one is put option. So the option which gives right to purchase, the option which gives right to purchase is considered as call option, and the option which gives right to sell is known as put option. So generally, whoever is holding that particular option, it gives a right to him to purchase a particular financial instruments at a particular time period. So these are nothing but options. So options are nothing but derivative instruments. Options are derivative instruments. Now here you can see, if you see the definition, an option is a right but not an obligation to buy or sell a particular good at an excised price at or before a specified date. Now just let me give an example so that you can easily understand. Before going to shares, I will try to take an example of the common items. Yeah. Now let us assume that every day you can see you can see the fluctuations in the crude oil prices are nothing but every day petrol prices are fluctuating. So every day it is increasing by 0.3 to 0 point something. So depending upon the international crude oil price, so the price of the petrol and diesel is changing in our India. It means there is no fixed price for the petrol and diesel. It completely depends upon the price of the crude oil in the international market. I think most of you might be knowing that. Now we'll try to take this petrol as an example for this particular options. Now let us assume that I want to, I'm expecting that in future, I'm expecting that in another, let us assume that exactly within 1 month. So I'm expecting that within 1 month, the petrol prices is going to be 90 rupees. The liter petrol cost it will be 90 rupees. Suppose, let us assume that today date is 1st July 2020. Now exactly on 1st August 2020, I am expecting petrol price to be increased by 90 rupees. So my assumption is that there will be a hike in the petrol price. This is my assumption. Uh, Now let us assume that yes, one more student joined. Yeah, Vaishnavi, I'm audible to you. Amna, shall I start the session or should I wait? Because this is very important concept because I don't, if students join in between, I think they might feel difficult to understand this. Shall I continue with my session or should I wait for 2 or 3 minutes? Yeah. So whoever joined late, just we started discussion about the options. Once again, I am repeating. So options are derivative instruments which gives the right to the holder to exercise, which gives a right to the holder whether to purchase or sell. So do remember that options are derivative instruments. Options are considered as derivative instruments, and the objective of these options is to minimize the risk. Now we try to understand this particular option with an example so that you will be clearly knowing. So generally options will be of two types. Now one is call option and the other one is put option. Now we'll try to understand with an example. Now nowadays you can see that there is a huge fluctuations in the petrol prices. Now generally in India, there is no fixed petrol or diesel price in India. So the petrol and prices will every day it fluctuates according to the international crude oil price. So if there is any change in the international crude oil price, so definitely the petrol prices or diesel prices will fluctuate in India. Now let us assume that. So I hope my voice is clear for all. Yeah. So let us assume that on 1st January 2020, on 1st January 2020, the petrol price, the price of the petrol on 1st January 2020, let us assume that it is 80 rupees. So it is 80 rupees. Now let us assume that on 1st February 2020, I am expecting that the petrol price will goes to 90 rupees. It means I am having an assumption that there will be an increase in the petrol price in a span of 30 days. So in a span of 30 days. Now this is the assumption of Mr. X. So this is the X assumption. Now according to Mr. Y, so if you see the Y assumption, he thinks that anyway on 1st January 2020, the price of the petrol is 80, but he believed that the price of the petrol will be going to be 70 rupees exactly after 1 month. It means two different persons are having two different opinion on a single product or a single good. So X believes that petrol price will goes to 90 rupees after 1 month, but Y believes that petrol price goes to 70 rupees after 1 month. So two different persons are having two different assumptions on a single product. Now we try to apply the call option to this particular example. Now these two persons entered an agreement. So the agreement is so according to that particular agreement, X will have a right to purchase, X will have the right to purchase the petrol at 85 on 1st February 2020. So let us assume that on 1st January 2020, both X and Y entered an agreement. So according to the agreement, X will have a right to purchase the petrol at 85 rupees on 1st February 2020, irrespective of the market. So in order to get that particular right, he will be paying a premium amount, he will be paying a premium of, let us assume that 2 rupees. So this is their agreement. So the agreement between X and Y is that X will have a right to purchase. It means have a right to purchase means on the day of 1st February 2020, Y need to sell petrol to Mr. X at a price of 85 irrespective of the market price. In order to sell that particular petrol to Mr. X at that particular price, he will be charging a premium of 2 rupees. A premium is nothing but the premium which is given, the premium which is charged by the person who is giving this right to the holder. So in order to get the right, the holder will be paying the premium amount. So this is nothing but a call option. So once again I repeat, two different persons are having two different perceptions on a single product. X believes that price will be increasing, Y believes that price will decrease. So these two persons entered an agreement. So according to the agreement, on 1st February 2020, X will purchase or Y need to sell the petrol to Mr. X at rupees 85 irrespective of the market price. So this is a agreement between X and Y. So in order to get that particular right, here if you carefully observe, X is purchasing a right to purchase a specific product at a specific price. In order to get that particular right, he needs to pay certain compensation to the giver. So the compensation is nothing but premium. So the premium is 2 rupees. I hope you understood this particular example. So this is a perfect example for call option. Now let us assume that, yeah, Amna, any question? So here I can see that you raised your hand. Any query from your end? Okay, well, no problem. So is this example clear? Now let us assume that on 1st February 2020, on 1st February 2020, the market price of the petrol is 100 rupees. On 1st February 2020, the market price of the petrol increased to 100 rupees. If the market price increases to 100 rupees, so who will be benefited by this? Hello. Hello. Am I audible? So on the day of agreement, as I said, he will be purchasing from the open market at 100 rupees, and he will be selling the same petrol to Mr. Y at 85 rupees, and he will be getting a loss of 15 rupees. But he already received a premium amount of 2 rupees. The total loss faced by him is 13 rupees. Now, can anyone, let me give one more example. Yeah. Suppose if the market price is, let us assume that it decreased to 80 rupees. Now, who will be getting profit and who will be getting loss? Instead of 100, if the market price decreases to 80 rupees, who will be getting profit and who will be getting loss? Okay. Vaishnavi, can you tell me how much loss will X will get? So, what will be the total loss of Mr. X in this case? Yes. So, actually, market price is 80 only. Now, so you are saying that the total loss faced by Mr. X is 5 rupees, right? Is it right? Once again I repeat, if the market price is 80 rupees on 1st February 2020, so what will be the loss suffered by Mr. X? Is it the difference 5 rupees or any other answer? Yeah. Now in this case, if the market price is less than the strike price, or if the market price is less than the agreement price, then what X will be doing is he won't exercise the option. So that is the reason why we are saying it as an option. The option holder will have a right either to exercise it or to reject it. Now in this given example, X is a option holder because he is purchasing the right by paying a premium of 2 rupees. Now if you purchase this by paying a premium of 2 rupees, exactly, very good. He will be losing only the premium amount. Once again, I repeat, in case of options, the option holder will purchase a right by paying the premium. Now, this option, for in case of option holder, it is not compulsory for him to exercise the option. He may exercise the option, he may reject the option. Now, in the given case, if the agreement price is 85 but the market price is 80, simply what he will be doing is he will breach the agreement or nothing but he will simply cancel the options. So that he will be losing only 2 rupees, that is premium amount, and this 2 rupees is nothing but loss. Now, technically speaking, if this option holder or if any of the party of this option receives profit, the profit is known as in the money. So, generally, in case of options, profits is nothing but in the money. We'll say it as in the money. And if no profit, no loss, we'll say it as So if no profit, no loss means generally we'll say it as at the money. And in case of loss, we'll say it as out of money. I hope this is clear. In case of option, if either of the party gets profit, generally that is known as in the money. If there is no profit or loss, we'll say it as at the money. And no loss, and if the case loss means, we'll be saying it as out of money. I hope this is clear. And let me know if you have any query regarding this. Yeah. Now, in this given example, can anyone say what will be the situation of Mr. Y? Whether he will be in the money, at the money, or out of money? From the from Mr. Y point of view. In the given example, what will be his situation? In the money, at the money, or out of money? I believe my question is clear to all. Can anyone say the position of Mr. Y? Suppose in the given example, the agreement price is 85, but the market price is 80. Now, from the Y point of view, what he will be getting? In the money, at the money, or out of money? Okay, in the money, yes, good. Suppose if the market price is 100 rupees, now what will be the situation of Mr. X? Suppose if the market price is 100 rupees, then what will be the position of Mr. X in these three? Okay, as you said rightly, in the money. Now, can I know the exact value of in the money? So, what will be the in the money value of Mr. X if the market price is 100? Once again, I repeat my question. As you said, as you rightly said, definitely X will be in the position of in the money only. Now, what will be the exact amount of in the money in case of Mr. X? 15 rupees. Once see the question, Vaishnavi, properly. Is it 15 rupees? So in case of Mr. X, the price difference minus the premium which he paid. So the price difference is 15 rupees and already he paid a premium of 2 rupees. Then in the money of Mr. X is 13 rupees. I hope I am clear. Now here an example is given. A call option on shares in ABC PLC. A call option on shares in ABC PLC might give its holder the right to purchase or right to buy 2000 shares in ABC PLC at a fixed price on or before a specified expiry date for the option. So just they gave an option example for the call option. Now put option means we discuss about the call option. Call option gives a right to purchase to the holder. But in case of put option, it gives a right to sell to the holders. So when it comes to the put option, here I will be writing. So the first example which we discuss is related to call option. Now if you see the second one, that is put option, as I said, in case of call option will give it gives a right to purchase to the holder. But in case of put option, it gives a right to sell. Now we'll try to understand this with an example. Now we'll try to discuss with an example. Let us assume that on 1st January, on 1st July 2020, 1st July 2020, Wipro company share. So on this particular date, Wipro company share value, market share value of the Wipro company is 100 rupees. So the market value of the Wipro company share is 100 rupees. Now let us assume that on 1st August on 1st August 2020, on 1st August 2020, X believes that Wipro company's share value will decrease to 60 rupees. And Y believes that Wipro company's share value will increase to 101 rupees. So I'm expecting everyone to please focus on this. On 1st July 2020, actually the present market price of the company share is 100. But exactly after 1 month, X believes that its share price decreases to 60 and Y believes that its share price will increase to 101. Now in this case, these two persons entered a contract. So the contract is X purchased a call option X purchased a put option with a price of 85 and agreed to pay premium of 3 rupees. So this is an agreement. So X purchased a put option with a price of 85, agreed to pay a premium of 3 rupees. It means that on 1st August 2020, X will have a right to sell. X will have a right to sell the Wipro company shares to Y at 85 rupees irrespective of the market price. In order to get that particular right, X is paying 3 rupees premium to Mr. Y. X is paying 3 rupees premium to Mr. Y. Clear? Now in this case, if the market price on that particular date, let us assume that if the market price of this particular Wipro company on that particular date, if it is around, let us assume that 75. Now, can you say whether X will be getting in the money or out of money? Here, put option means it completely deals with right to sell. So there is an agreement between X and Y. So agreement says is X will be having a right to sell the Wipro company shares on 1st August 2020 at a price of 85, irrespective of the market. Now let us assume that, and for that he paid a premium of 3 rupees to Mr. Y. So on 1st August 2020, the market price is 75. Now my question is whether X will be having in the money or out of money. If it is in the money, what will be the amount? Yes, very good. Definitely X will be having in the money, and the amount of in the money will be first the difference. So 85 minus 75, the difference is 10 rupees, and from that if you deduct the premium amount of 3 rupees, 7 rupees will be the in the money value. Now we need to deduct the premium amount. Okay. Yeah. So I hope now you are clear with this call option and put option. Yes. Now we'll try to understand certain terminology which we use. So generally premium is considered as a cost of the option. In order to get the right, the option holder will be paying the premium. And here we need to mainly focus on two important types of options. One is European style of option and other one is American style of options. Two options are there, European style and the other one is American style. Now if you see the European option, it can be exercised on their expiry date only and not before. It means in the given example, here the expiry date is 1st August 2020. Now if you are dealing with the European date, the option can be exercised on that particular date only. We cannot exercise before 1st August 2020. It should be exercised only on the 1st August 2020 if it comes under the category of European options. So according to the European options, options can be exercised on the due date, not before the due date. This is according to European option. But according to American option, the option can be exercised any time before the due date. Suppose in the given example, I said that the due date is 1st August 2020. It means from 1st July 2020 to before 1st August 2020, any day that American option can be exercised. So the major difference between American option and European option is European options can be exercised only on the due date, not before the due date. But in case of American option, it can be exercised any time before the due date. So that is a major difference between American option and European option. And the next one, the exercise and strike price. So here the strike price, if we can say the exercise, we can say it as exercise price or strike price, the fixed price at which good may be bought or sold. Now here, this particular 85 rupees, in the given example, this 85 rupees should be considered as exercise price or the strike price. It means at this particular price, the option will be traded. So the price at which the option will be traded should be considered as exercise, or we can also say it as strike price. So I hope you are clear with the difference between European option and American option. Any question? Difference between these two, European and American. Next concept is option value. So generally, if you consider the major factors which determine the price of call options, so the elements which influence the price of the options. So the first element which influence the price of option is price of the underlying instruments and the exercise price of the underlying instruments and the exercise price. So these are the two important things. Suppose in the previous example, the price of the underlying means the Wipro company share. The market price of the Wipro company share is nothing but price of the underlying asset. Exercise price is nothing but the price at which the option is traded. So the price at which the option is traded is known as exercise price, and the market price of the Wipro company share in the given example which we discussed, that is nothing but the price of the underlying instrument. So the price of the underlying instrument and the exercise price influence the price of the call option. So the option value will be decided on the basis of this particular underlying price, underlying instrument's price. The second one is time to go to the expiry. So what is the duration? Generally, the maximum time period in case of options is 90 days. It should not be more than 90 days. Do remember. So do remember the maximum time period. The maximum time period in case of options is 90 days only. So depending upon the duration also, the price of the option will change. Now generally, if the option duration is high, if the option duration is high, in that case, the option value will be generally higher. If the option duration is less, the price of the option will be less. So that's why we can consider the duration of the options as a factor which influences the price of that particular option. And the second one is the volatility of the underlying asset. So volatility means the changes, how frequently the underlying assets prices are changing in the market. Suppose, let me give an example. If you take an example of banking industry and infrastructure industry, if you see the last 10 years statistics of our Indian stock market, maybe the Bombay stock market or National Stock Exchange, generally the banking sector stocks are more volatile compared to the infrastructure sector. It means the fluctuations in the share prices of banking sector is very high compared to the fluctuations in the share prices of infrastructure. So that's why the volatility of the underlying instrument should also be considered for valuing the options. And the second one is interest rates. So interest rates prevailed in the economy. So whatever interest rates which is prevailed in the economy, that is also an important factor for the option value. Risk-free rate of interest. So at what value we can expect a minimum rate of interest. So without facing any risk, how much interest we can expect? That is nothing but risk-free rate of interest. So this risk-free rate of interest is also an important factor for the option value. And the next one, whether a European option or American options. Now here generally if you see, American options are more expensive compared to the European options. Do remember. Generally depends upon the type of options also. American options and European options. I hope you might understood the difference between these two. Now generally the price of American options are generally high compared to the European options. So this should also be considered for valuing the price of the options. So just once go through these particular 6 important elements. If you have any query, you can ask me on these 6 elements. So these are the 6 important factors which we need to consider for valuing an option price. Yeah. Now, how interest rate will affect the option prices? Suppose, let us assume that if the interest rates are less in an economy, if the interest rates are less in an economy, then most of the investors, they will be searching for an alternatives. Suppose, let us assume that if you are having 1 lakh and the interest rate, if you are having 1 lakh and if you want to get any return on that 1 lakh, the first option available to us is FD. Now, let us assume that there is a significant decrease in the FD rate of interest compared to the previous year. FD rate of interest is 10%. Now, according to the new repo rate which is given by the Reserve Bank of India, now the repo rate decreased to 8.5%. It means the interest rate has been decreased compared to the previous year. Now, in that case, what investors will be doing is they will be mainly looking forward for these kind of alternative instruments so that they can get maximum return. Because if the interest rate in an economy increases, they will be showing interest to invest in the risk-free instruments only. But if the interest rate is significantly decreasing, then definitely they will go for the alternative options. Now, if the interest rate decreases means the demand for the options will increase. If the demand for the options increases, automatically the price of the option will also changes. So that is the reason interest rate will affect the pricing of the options. I hope I am clear, Vaishnavi. Yes. So these concepts I already explained. If the exercise price for the option is more than the favorable for the option holder, then the current market price of the underlying asset, the option is said to be in the money, out of money, at the money. So in the money means profit, out of money means loss, at the money means no profit, no loss. Yes. Now the most important concept, that is Black Scholar's option pricing model. Now just I am expecting everyone to once just focus on this particular formula. Black Scholar's option pricing model. Now here in this example formula, if you say option price is denoted as C, C is nothing but the price of the option, and option price is equal to PA and D1, nothing but deviation, minus PE and number of deviations for the given period of time. Now they also gave the formula to calculate the D1 value, and we can find the formula to calculate the D2 value also. Now we'll try to understand this particular formula so that here the first important thing is PA, means the price of the underlying instrument. So what is the price of the underlying example, the current share price if the pricing an equity call option. So the current market price of the underlying asset. In the previous example, if you remember, we took an example of Wipro company share. So the present market price of the Wipro company share is considered as PA. So the current share price of Wipro company, just I'm taking the Wipro company share as an example. So the present market price of the Wipro company share is considered as PA. And the second and the most important thing is deviations. So here if you see, the probability that the normal distribution is less than the standard deviation above the mean. Now in this what does it means we need to calculate the difference between the exercise price and the market price for a given period of time. Suppose example, if the option period is for 1 month, let us assume that if the option period is for 1 month, so what is the probability of changes, what is the probability of difference between the exercise price and the market price in the span of 1 month? We need to calculate the mean for that, and don't and here they won't be asking you to calculate the problem, but you need to understand the formula. So the first important thing, if the option period is 1 month, so in a span of 1 month we need to calculate the mean average market price, that is nothing but the mean, and with that particular mean we need to calculate the difference between those, what is the difference between these two. So now let me give an example for this. Suppose if the option period is 30 days. Now here if you see, for the first 1 to 10 days, the probability of changes in the market price of the share, nothing but the probability of difference between the exercise price and the market price, let us assume that the probability is 0.10. And from 11 to 20 days, let us assume that the probability is 0.20. And from 21 to 30 days, the probability of changes is, let us assume that 0.7. So these factors, this probability we will be considering. Yes. So this probability we will be applying for calculating this. So the probability that a normal distribution is less than the standard deviation above the mean. Now it means that what is the probability of changes between the average mean value, or nothing but what is the average change in the percentages and how it is different from standard deviation. So it will be given in the question. So that will be denoted as ND1. So in order to get the D1, we will be applying this. Now here if you see, the probability of A are nothing but the price of the market price of the share, and PE is nothing but I already mentioned the exercise price. Exercise price is nothing but the market, the agreement price. So the difference between the agreement price and the market price, and most importantly if you see the standard deviation. So this is very very important. The standard deviation of the underlying instruments, it means, I think you might be knowing what exactly standard deviation says. The deviation of an individual observation from its mean is nothing but the standard deviation. Once again I repeat, the deviation of an individual observation. Suppose let us assume that by the past history we got to know that the price of the underlying assets will have a mean of 10%. It means there will be a fluctuation of 10% in the sale prices of that particular underlying asset. That is nothing but a mean. Now standard deviation means in the period of 30 days, how individual observation is different from that particular mean. So that is nothing but the standard deviation. And here don't worry, they won't be asking you to explain all this, but you need to understand what exactly this. In a simple way, we will be calculating, we will be applying the Black-Scholes formula by calculating the deviation of an individual observation from its mean observation. So that factor we will be considering in order to calculate the option pricing. So here you need to mainly remember that we will be completely focusing only on the deviation of underlying asset only. So on the basis of deviation of underlying asset, we will be considering. That is one factor. In addition to that particular factor, second factor is duration of that particular bond. Now duration of that particular option, whether the option is for 2 months or 3 months or 90 days. Do remember the maximum, the option duration is only 90 days. So that duration we will be denoted, it will be denoted by using the P value. If you remember, I said 6 important factors if you remember. One is the market fluctuations of the underlying asset, the first point. Second one is duration of that particular option. This is the duration, it will be denoted as T. And the second important thing, if you see, the risk-free rate of interest, that will be denoted as R. I hope, did you understood this formula? In this Black-Scholes option, we are mainly following the criteria. First one will be price fluctuations of underlying asset. First one, that will be denoted by ND1. And the second one is the duration of the option, that will be denoted as R. And the third one, the risk-free rate of interest which is prevailed in the market. Okay, that will be denoted as R and duration will be denoted as T. Now, most importantly, you need to remember that this, then the basic form of Black-Scholes model gives the value of European call options. Now, here you need to remember that this Black-Scholes options, this Black-Scholes option pricing model, generally we will be using only for European options, not for the American options. Do remember. Now, what is the difference? Can anyone say the difference between American option and uh, European option? You can see here. So do remember, in case of European option, it can be exercised only on the due date. But in case of American option, any day before the due date. So these Black-Scholes option generally will use for European options only. I'm not saying that we should not use for American options, but generally we prefer this for European options only. So once again I'm repeating, Black-Scholes formula mainly focus on the major elements like the deviation between the strike price and the exercise price, and the number of what duration of the option, that is denoted as P, and the risk-free rate of interest, that is denoted as R, and the deviation, which is denoted as ND1. So these are the major factors which we need to consider for calculating the Black-Scholes option pricing model. I hope this is clear. So if you have any questions on this, you can ask. And do remember here, volatility means the percentage of change in the market prices, change in the prices of that particular share in the market. That is nothing but volatility. And when it comes to the application of a Black-Scholes model for put option, so how to price the option in case of put option. So generally put option can be calculated by using this put quality formula. This is known as put call parity formula. So here the value of a put plus current value of the underlying security is equal to value of a call plus present value of the exercise price. So by you applying this put call parity formula, we can calculate the option price of a put option. So the price of a put option can be calculated by using put call parity formula. Now here you can do value of a put is equal to current value of the underlying security. Do remember, current value of the underlying security is nothing but what is the present value of that particular share is equal to value of the call plus present value of the exercise price. Now generally these three will be available. If you substitute it, we will be getting the value of a put. So the formula which we use to calculate the option value of a put option is put call parity formula. So any questions please you can ask on this. Now, if you see the limitation of this particular Black-Scholes model, it assumes that no dividend are paid in the period of the option. Now, first assumption, generally when we are dealing with the option, we'll assume that dividend will not be paid. It means that there will not be any concept of revenue return. So, this is one of the limitation of Black-Scholes formula. No dividend is paid in the period of option. And the second one, it applies to European call options only. If the above assumptions holds true, then it can be used to value the US call options also. So generally, I am not saying that we can't apply the Black-Scholes formula for American options, but mostly we'll be using this only for the European option, not for the American options, because there is no concept of dividends on that. And the third limitation is it assumes that the risk-free rate of interest is known and is constant throughout the options life. But practically, if you see, it is very, very difficult to predict the risk-free rate of interest. Practically, it is impossible. We can use the word impossible to predict the risk-free interest of an economy. So that's why that is one of the limitation. And the next one is the standard deviation of the return of the underlying security asset must be accurately estimated and has to be constant throughout the options life. So it means that the standard deviation of the returns, it should be accurately estimated, but a specific important point that it should be constantly maintained. But practically, it is very difficult to have a constant standard deviation throughout the duration of an option. So in practice, will vary depending on the period over which the calculator. Unfortunately, this model is very sensitive. So as I rightly said, if the option value, sorry, if the option duration is 30 days, then we can easily apply this Black-Scholes model. But if the duration is more than 30 days, it is very difficult to get a constant value on the standard deviation. And the next one, it assumes that there is no transaction cost, but practically it is impossible to trade a financial instrument without a transaction cost. Definitely transaction cost will be there. So, but in Black-Scholes formula, it assumes that there is no transaction cost on or tax effects involved in buying or selling the option. But practically, can we purchase an option without a transaction cost? No. So that's why this is one of the limitations. Now the second one is, if the dividends are paid before the expiry, you need to calculate a dividend adjusted share price. Do remember. Now if any dividend is payable before the expiry of the option, in that case we need to calculate dividend adjusted share price. Dividend adjusted share price means we need to add this dividend also in the share price. Suppose let us assume that at the time of agreement, the share price is 10 rupees and the market price is 15 rupees. But during the period, company paid a dividend of 1 rupees. So this 1 rupee should also be considered when you are pricing the options. And simply deduct the present value of the dividends to be paid before the expiry of the option from the current share price. Now it means, as the given example, so from the current share, suppose let us assume that the agreement price is 10 rupees and exactly after 1 month the company will be paying a dividend of 1 rupee on that. Now that 1 rupee present value should be deducted. If the present value of the 1 rupee is 0.95, so from 10 rupees we need to deduct the 0.95 and 9.1 should be considered as the strike price. So in a simple way, if any dividend is payable on the options, the dividend should be converted into present value and the present value should be deducted from the strike price when you are applying the Black-Scholes formula. So these are the limitations of this particular Black-Scholes formula. Yeah. So this delta hedge, and let me ask, how many of you referred the option pricing? Because yesterday I asked to refer this. Can I know how many of you referred this option pricing chapter? Yes, Amna and Vaishnavi. What about others? Did you refer this option pricing yesterday? Yeah, what I am asking is, yesterday I asked you to refer this option pricing chapter. So, did you refer that? Did you refer this chapter yesterday? Okay. What about others? Okay, only introduction to the concept. No issue. Yeah. So this delta hedge and real options, this is generally believed as uh, as a concept which we practically apply. Now we'll try to understand what exactly this concept says. So the delta hedge is an option position which added to a portfolio causes the portfolio to be delta neutral. Now here this is very simple in case of this delta hedge. Now in case of delta hedge, what we'll be doing is we'll try to calculate the option value with the fluctuations in the price of the options and with the fluctuations in the price of the underlying assets. Once again I repeat. So according to the delta hedge formula, we'll try to calculate the value of the option by comparing the fluctuations in the price of the options and by comparing the fluctuations in the price of the underlying asset. Suppose here, so delta hedge is an option position, do remember, which when added to a portfolio causes the portfolio to be delta neutral. The portfolio consisting of a quantity of underlying instrument and the quantity of options. So the number of call options, now this is very important. The number of call options to sell is equal to number of shares held or the number of shares to hold into number of call options to sold. Now do remember in this case, in order to predict the exact number of call options to be sold in the market, we will be generally applying this delta hedge. So this delta hedge will be mainly comparing the fluctuations in the share prices of both the options and the underlying assets. Suppose, let me give an example. If the fluctuations of a particular underlying asset, if the fluctuations in the share price of a particular underlying asset is more, if it is more sensitive, in that case we can issue more call options. Suppose two companies are there, one is Infosys company and the second one is Wipro company. So over the period of 1 month, Infosys company share price had followed a lot of fluctuations. It means it increased, there was an increase, decrease, increase, decrease. So there is a frequent fluctuations in the Infosys company. But when it comes to the, what is this, Wipro company, there was no that much frequencies, nothing but that much fluctuations. So if the share price fluctuations are high, generally we can issue more number of call options. If the fluctuations are less, we can issue less number of shares. So this concept is nothing but delta hedge. And the most practical concept, that is real options in the investment appraisal. Yes. So real option theory, generally it mainly focus on attempts to classify and value flexibility. Yeah. Hello. Am I audible? Hello. Yeah. Now, when it comes to the real options, this is very important for our advanced financial management. These mainly focus on the investment appraisal decisions Suppose if the company want to start any new project, and if the new project includes both non-financial assets and the financial assets. So generally we can say non-financial assets as physical assets. So instead of physical assets, I am saying it as non-financial assets. So if any project includes both the non-financial assets and the financial assets, in that case, we will be applying, uh, in order to calculate the net present value, we will be applying this. So they are the option on real physical assets to distinguish between financial assets. Such options have a value that should be added to the conventional NPV. So let me explain. Example is, if there is any investment on both physical or non-financial asset and the financial asset, in that case, how we need to take, how a finance manager can take a dividend decisions. Now, do remember, when we are dealing with these kind of real options, we need to go for a strategic net present value. And how we will be getting the strategic net present value is your conventional NPV, the process which we apply for calculating the NPV, plus the value of the real options. Now, value of the real options means, let us assume that I want to, the company decided to invest in a project, and the project will give returns to the company for a period of 10 years. So I'm expecting everyone to please focus. So the total life of the project is 10 years, and the project needs initial investment of 1 crore. Subsequently, after 4 years, it requires 2 crores of investment, and after 5 years, it requires, sorry, after another 2 years, it requires another 3 crores of investments. So this is the investment of that particular project. Now, what finance manager did is, initially he borrowed a fund of 1 crore 50 lakhs. That surplus 50 lakhs, which he don't need in the initial period, he invested in the financial instruments. Now, after when the funds are required, suppose let us assume that 2020 I started a project with 1 crore. In 2023, another 2 crores I need as an investment on the same project. It means in 2020 I don't need any funds. I need only 1 crore, but this 3 crores requirement is in 2023. So what finance manager will be doing is, he will be strategically investing that amount in 2020 so that it can generate 3 crores rupees in 2023. It means the investment includes both a physical investment, and the second one is financial instrument, or nothing but investment in the financial instrument, that is a purchasing options. So while calculating the NPV, we need to calculate the NPV plus the expected return or the expected value of the options which we need after a period of 3 years. So this is nothing but real options in the investment apply. It means how much amount today I need to invest so that I can get 3 crores rupees after 3 years. So that is nothing but the value of that particular real option which we can get after 3 years and which we can invest in that particular project. So this is nothing but real options in the investment uprise. So NPV, so in a simple way, what you need to remember, if you are investing in a physical asset plus a financial instruments, while calculating the NPV, in addition to the convenient NPV, we need to add the value of the real option. Then only we can calculate the strategic NPV. Now, the best example for this is, if you remember yesterday's case. Yesterday case, we started a company proposed to start a project in a FLITS country, a foreign project, and that particular foreign project, the foreign government, they gave a tax exemption. So the tax exemption is, they need to invest the same depreciation amount, and whatever tax, whatever they need to invest a depreciation amount on that, the government will be paying 15% as return, and no need to pay tax on that particular 15%. If you remember yesterday we discussed this. These kind of case is nothing but a project which includes both the financial asset plus the physical asset. So this is about real-time options in the investment crisis. I hope you understood this. Yesterday we calculated a problem, we solved a case on this concept also, where we calculated NPV and we also calculated NPV on government bonds in yesterday's case. So that is the best example for the real options in the investment crisis. Is this clear? Sorry. I think some problem with my note. Tomorrow we'll be discussing about the chapter 9, that is introduction to risk management. So I'm expecting you to please refer this risk management chapter. Is it clear? Okay. So we'll meet tomorrow session. Okay.